This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So let's look at the other accounting standard that is contained within the chapter. It's only very short, but is linked to IAS 2 at the end, okay? Because IAS 2 is all about inventory, isn't it? So goods that are manufactured or goods that are bought for resale within the course of your normal business, okay? Now, what you could have is you could have a business that actually produces the goods that needs to be sold. So you're actually the grower of those goods. So if you're a farmer or if you're a wine producer, then agriculture as a standard in IS 41 would be relevant to you, because what you've got is a three-stage process in terms of how we get to that inventory at the end. The first process or the first step within there is looking at what is referred to as your biological assets. Okay, a biological asset is a living plant or an animal. Okay, because what you have is that you have maybe your apple trees. Okay, that is a living plant. You might have your grapevine, which again is a living plant, or you might have your living animal. It could be a cow, it could be a sheep, any animal that is then used to give you some form of agricultural produce. Okay, because what then happens is that biological asset will then go on to give you some agricultural produce. So if you have an apple tree, it will go through there and give you apples. If you have a grapevine, then that will go through there and give you grapes. If you have a sheep, okay, I think the note there says, yeah, two sheep might get together, and therefore there is a lamb that is produced, and that becomes your agricultural produce. Okay, it's like magic, isn't it? Two sheep coming together, and it's like, woo. Or would it be two sheep? Would it be a sheep and a ewe? Anyway, doesn't matter. Okay, you've got a little baby lamb, which is going to disappear off onto the shelves of the supermarket to become inventory. Okay, the key bit there is that you've got this agricultural produce, okay, that comes from the biological asset. So if you think about a cow, that's a biological asset. Then the agricultural produce could be the milk, okay, or it could be that the carcass of the cow that goes off then to create your leather goods, okay, and then effectively the carcass is what then goes into the inventory, isn't it? Okay, because that's then turned into leather, which goes into the leather jacket. Or if you're looking at, say, the cow and you've extracted milk as an agricultural produce, that milk will then go into cheese. Okay, so somebody will buy the milk to manufacture the cheese, and that's when it then becomes the inventory, isn't it? And you value it at the lower of cost and NRV. Okay, but from the farmer's perspective, from the wine grower's perspective, they go from the grapevine to the grape to the wine. Okay, from the farmers or the wine growers perspective, you can't just wait until we get to the inventory to value the goods. We've got to go through the processes first to be able to value that biological asset. If you think about the definition of an asset, it's a resource controlled by the entity that gives you future economic benefit. Hang on, we can go through there and control the grapevine, control the cow, control the sheep. Okay, might be a bit difficult controlling your sheep. That's why you need a sheepdog to herd them around. But we are controlling it, and it's going to give you future economic benefit in terms of the agricultural produce that you can get. Or if you think about the sheep or the cow, you could actually sell on the sheep, or you could sell on the cow directly. Okay, so that they would be referred to as consumable biological assets. Okay, whereby your apple trees, your grapevines, they would be more bearer biological assets, and they actually fall outside the scope of IS 41. But I don't want to get too consumed within that. Okay, I just want to think about the biological assets going into agricultural produce into the inventory. Okay, so we as the farmer, we as the wine grower or the wine merchant will need to go through there and account for the biological asset and account for the agricultural produce. So what are the rules? Very simple. When you've got your biological asset, so you've got your little apple tree or grapevine that is growing, it's there at your fair value. So there would be an attributable fair value because people will be able to go through and buy and sell these trees at particular points in time, less the estimated point of sales, okay, or point of cost sales, okay. Oh, sorry, point of sale cost, if I can get my word right. So we're thinking there in terms of any commissions that you might have to pay to sell the goods, or any levies, so taxes, okay. So it's like your net selling price, isn't it? Key bit is that it's done initially. So initially when you start off with that biological asset, and then at every reporting date, okay. Similarly, when you're there in terms of your agricultural produce, so whether that's the apples, the milk, the carcass, that is sold on a regular basis. So you will be able to go through there and look at a fair value using IFRS 13. Again, we take the fair value and then we take the point of harvest fair value less the point of sales costs. Okay. So the key difference here with the agricultural produce is that the fair value is at that point of harvest, whereby the fair value of the biological asset is going to be at different points in time over whereby that biological asset is growing, and as it grows and is able to produce more agricultural produce, its fair value will increase. Its fair value could go down, if there's a drought or if there's bad weather and all of a sudden your grapevine doesn't produce as much. So the fair value could actually go down as well as going up. Okay, but the longer you've got the asset for, the more likely the fair value is going to increase as that biological asset itself grows as well. Okay, is able to produce more agricultural produce. Okay. Then once you've got your agricultural produce and you've got the fair value at the point of harvest, less those selling costs, that then now becomes the cost within your inventory. Okay, so if you've got your agricultural produce as milk, we know the fair value of the milk. That then goes into making cheese. So that fair value less the point of sales costs for the milk is now the cost of the milk that feeds in to the cheese inventory. Okay, there we go. That's effectively the basic rules. There's just points to note just underneath that there, in that when you're looking at the fair value, either at the point of harvest, is it there for your agricultural produce, or the estimated fair value of the biological asset, any gains or losses go directly to profit or loss. And then what you would need to do is within the notes to the accounts, you would need to disclose what that change is due to. And is it due to just a physical change as that biological asset has grown and therefore has an increase in its fair value? Or is it just down to a price change? The fact that you've got this biological asset, it's reached its highest maximum producing potential. So there's not going to be any more physical change, but therefore it might be just to changes in the market. So therefore a price change. The likelihood is that it's going to be down to both a physical change and a price change. Okay, but that's there for disclosure in the back within the notes. That's not going to be examined in terms of any computational aspects at this level. I think that's more likely to be seen in strategic business reporting, and we'll see that when we get to SBR at a later date. Okay, let's focus on financial reporting first, shall we? Other bits and pieces, just a note at the bottom. If you've got some agricultural land, whereby that's the land whereby the biological assets are growing, so that's where you've got your apple trees, your grapevines. It's land, doesn't matter what's growing on it, whether it's apple trees, whether it's a grapevine, whether it's a building, it's land, isn't it? So therefore it is IAS 16. So do not depreciate it. And then milk quotas, they are an intangible. So under IAS 38, one of those few intangibles that could possibly be revalued as there is an active market. But don't account for milk quotas just because milk is an agricultural produce. A milk quota is allowing you to produce a particular amount of milk. Okay, so you have control over the amount of milk that you can produce. Nobody else can produce that amount of milk. It's giving you those benefits that are going to be probable, and you'll be able to measure that value of the milk quota reliably. So it meets the definition of an intangible, and you will therefore account for it under IAS 38. And then small, tiny bit there to do with your grant income. Grant income, you debit the bank and you just credit your statement of profit or loss immediately once we have met the conditions. Okay, so there's none of this deferred income approach of releasing it over a period of time to match the benefits that we get. For any agricultural activity, that grant income is recognised immediately, provided that it's unconditionally receivable, i.e. you've met the conditions. Okay, so there we go. Small little standard. You do see a lot more of it in SBR, but what we've spoken about there is pretty much all that you need when it comes to looking at it from a financial reporting perspective.